Good afternoon, everyone, and welcome back to Singapore Trading Festival 2022. Now, jointly organized by Singapore Exchange and Equities Tracker. In this session, our speaker will sharing on how to keeping your mind at ease in a volatile environment and what are some of the asset classes that investors should consider in a volatile 2022. Just on side note, the session happened in Conference Hall 1 and 2, and every session has a Q&A panel on the right for you to submit your questions. And by the way, the presentation are strictly the views of the speakers only. And now we have Mr. Adrian Chew, the Senior Vice President, Sales and Product Strategy of CSOP Asset Management, and Mr. Kenny Law, Associate Wealth Advisory Director and XUX Academy Trainer. Together, they were discussing the best asset classes for a volatile trading environment. And Adrian and Kenny, over to you.
Okay. Yeah. Good afternoon, everyone. I'm Kenny. All right. I'm an Associate Wealth Advisory Director of an independent financial advisor. Actually, during this period, it is not easy for the investor to ride through volatility. We have one event after another event. We have a spike in Omicron, then create the lockdown in China and some part of the world. And after that, followed by the interest rate hike, plus the Ukraine war. And now latest, we are facing the hyperinflation. As an advisor managing my client portfolio itself, I'm facing a lot of challenges in terms of the portfolio volatility. So this triggered me to really look at some of the asset class to really reduce my client portfolio volatility. And I come across that one asset class, which is pretty unique and not many people know, that really quite resilient during this period. And also the volatility is pretty low. So I take some time to really look at this China government bond, and I find that maybe this China government bond is one of the asset class that maybe investor can consider to include into their portfolio if they feel very uneasy during this volatile period. So I also chance upon that opportunity after speaking to CSOP asset management and Adrian to start to realize that actually investor can really take a look into this China government bond. So with my honor and also and also good opportunity to have Adrian online now to really share about this China government bond. So Adrian, maybe you can do some introduction of what is this China bond is all about, and also how the China bond market during this period in the rising interest rate environment, or even in the March 2020 market crash, and also the Ukraine and Russia war, how the China bond performed. Oh, Adrian, over to you.
Yes, thank you, Kenny, for the kind introduction and staging out the stage for me for today. And you have rightly pointed out that when the COVID-19 pandemic started in the March of 2020, and China being the epicenter of this health outbreak, Chinese government bond actually performed relatively stable against emerging market. And like you rightly also mentioned that the last 2 years has been very unique for us and for investors. Like as you say, events after events has actually happened around the world, and how investors are actually going to navigate through such tremulous times going forward. Right, a quick introduction to the Chinese bond market, and it is actually a market that is too big to be ignored. Right, China right now is the world's second largest bond market. With the onshore bond markets value at about $20.5 trillion as of December last year. This is actually second to the US market. Now, the Chinese bond market consists of, as you first mentioned, the Chinese government bonds issued by the Ministry of Finance of being backed by the Chinese government. Next is actually policy bank bonds as well, local government bonds, central bills, and of course, the corporate bonds itself. Now, in the recent years, Chinese government onshore bonds have actually gained much recognition, right, on the institutional level. You could see that more and more in global indices are actually recognizing Chinese government bonds and actually including them into their indices as well. And having said that, this helped to increase a lot of awareness internationally on the Chinese bond markets. In the past, for the last 2 years, the foreign investors holds only about 3.4% of onshore Chinese bonds itself, but that's actually gone up to 4.3% after the inclusion and a rising awareness of Chinese bonds itself. Even at 4.3% foreign ownership, it is still considered as the lowest among other major markets. And we believe there's huge potential for more inflows into these markets. And having said that, what are some of the characteristics of Chinese government bonds? It's offering about close to 3% yield with a strong credit rating of A+, right? Right. In a current low growth situation, a volatile market world right now, the Chinese government bonds offer a relatively high yield. That their 10-year bonds itself is offering a yield close to about 2.8%, right? And they are actually being ranked or rated by S&P of A+ with no history of default before, right? And with the credit rating of A+ is actually in the same category as Japan, one of the developed bond markets itself. And looking at the chart at the bottom left is that they're offering a yield of about 0.22, having the same credit rating of A+. And having the same top-notch investable grade A+ is actually one notch higher than BBB. And looking at BBB, you believe that having such a higher risk, definitely you are expecting a higher yield, right? And you could see that again on the chart, with a BBB kind of rating, the 10-year yield for their Italy is actually offering close to 2%. So you can see that strong credit rating, yet a relatively high coupon offered to the investors itself. Right. So next, how, Kenny, again, you have already mentioned, right? How did it perform in the March 2020 market crash due to the pandemic? Right now, we have interest rates going to hike. It's going to hike for six times, and it's been actually implemented at 25 basis points this month itself. The Ukraine Russia conflict, and how did the Chinese market perform during this situation? Right. If you look at looking at a chart at the left itself, Chinese government bonds actually offer potentially a safe haven kind of characteristics. Now, in March 2020, right, it was actually the peak of the COVID-19 pandemic. Global markets faced a sell-off. Despite being the epicenter of the outbreak, Chinese government bond performed relatively stable against emerging market, right? Again, you could see that from this chart during the green box itself, where the epicenter happened, this is actually because of the market sell-off. Everybody's reaching to the safe haven, where US dollar strengthened against the renminbi. But however, in terms of price and in terms of the performance after, is that you could see that they have actually managed to recover so quickly after the sell-off. And the reason for such strength in terms of recovery and outperformance is actually due to the PBOC, which is the Public Bank of China, easing measures that actually been implemented itself, very strict and swift reaction to curb the outbreak in the mainland China itself. That's the reason why they have actually first to have experienced the pandemic and the first to actually exit from the pandemic in 2020, right? And of course, the growing resilience of the renminbi itself. These are the three reasons why that the Chinese government bonds recover so quickly. Next, you're talking about the rising interest rates, right? My apologies on that. You could see that right now, we believe that the US and China are in a different economic cycle right now, right? The US is expecting persistent high inflation rate right now, while China is actually facing, they're past their peak in terms of the economic cycles, and they are slowing down due to the property market. So hence, the China PBOCs are actually adopting a different growth, a different monetary cycle versus the US. And having said that, the renminbi has kept very resilient, being due to the support of their current account and also by their trade surplus. And talking about trade surplus, last year alone, the trade surplus for China exceeded about 500 billion US dollars. So again, they're actually in a very good situation. And even with despite with the expectation of interest rate high, Chinese government bonds gained close to 8% in terms of USD for last year in 2021. Next is about the Ukraine-Russia conflict, and you could see that this conflict has actually very limited or have no impact at all for Chinese government bond performance. If you look at the period between February 21st to 28th, that's where the first outbreak of the conflict happened. You could see that the Chinese government bonds have actually was on the uptrend, right? It wasn't really affected by that thing, by the war itself. In fact, the war may pose a potential encouragement for Russian and institutional investors to even diversify their global reserve to adopt a renminbi in terms of their deposits and settlements in terms of their trades, right? This would definitely help to increase the usage in terms of renminbi, setting renminbi on a path of being the internationalized currencies going forward. Right, next, I touched about the property, right? So when you talk about property, definitely most of the questions in mind was actually talking about the Evergrande, debt issues. Has it affect the fundamentals of China bond market structurally? Right. So we believe that Evergrande issue definitely was a highlight of the Chinese credit bond market, but it had little or in fact no impact on Chinese government bonds. The reason is that Chinese government bonds are issued by the Ministry of Finance, while Evergrande is actually regarded as a corporate bond. So these are actually two different risk profile. And having said that, would there be a immediate kind of systematic kind of financial meltdown? And based on research report shows that Evergrande total exposure was actually about 0.22% of the entire China banking system loan system itself. So and most of these banks that actually have exposure to Evergrande are secured by projects and lands. Hence, the total cost or total impact to the banking sector is fairly limited in that sense. Now, over Evergrande's total, onshore bond outstanding is around 53 billion yuan as of September last year. And comparing, that's only actually about, if you look at the size of the Chinese onshore bond market, is about only 0.13%. So it's actually very small kind of exposure to the whole bond market in onshore itself. So the cool down in terms of the property market sector altogether, with the lower house prices, definitely going to create a overall kind of economic, definitely impact on China's overall economic growth, right? And that has been actually reflected on their weak consumption, their CPI data, low land transaction kind of volume, and that will definitely only affect potentially on the local government income. So to conclude on this question is that the default of the Evergrande other private developers definitely may cause pain to the economy as a whole, because the real estate sector contributes about 28% of China's GDP, and of course to the bondholders itself. But it will not definitely have any immediate impact on the credit and banking system, as long there is no huge meltdown in terms of the land and property prices going forward. Right. So just want to stress again that Evergrande is just is a corporate bond, while Chinese government bond is actually issued by the Ministry of Finance, backed by the Chinese government. Is actually of a different risk profile itself. Sorry, Kenny, are you saying something? Yes.
Yeah, Adrian,
Yes.
Thanks for sharing. It
Yep.
gives me a better understanding of this China bond.
Mhm.
It can be considered another safe haven during this volatile period. But how is the China bond market compared to other bond market like US, Asia Pacific, or European bond market? And how should an investor can consider to include this CSOP China bond ETF to their portfolio? Maybe you can just share some light on it.
Thank you. Yes, Kenny, very good questions. Those are very insightful questions. Now, when we are looking at the Chinese government bonds and how they compare to the other regions, be it emerging markets and developed markets, right, is that looking through the performance last year when you compare to the developed markets, right, 2021 in terms of US dollars, the Chinese government bonds were actually was actually producing a positive returns, right, in terms of price and coupon, close to about 8% return, while you could see that other countries are actually facing a negative returns in terms of US dollars. And when you put Chinese government bonds against the emerging market bond market, again, it actually have a positive returns in terms of US dollars to term returns when you compare to other countries such as Malaysia, Turkey, and other emerging market like Hungary and Poland. So when you put Chinese government bonds against these two regime, right, developed and emerging, they have actually performed very, very well. And why so? It's because of their characteristics, right? They have portrayed very strong safe haven characteristics, and we put it against for example, with developed bond market in a sense. When comparing in terms of yield to maturity, duration, risk, annualized return, annualized volatility, and you lump it together to reach a risk return ratio, Chinese government bonds have actually outperformed the US Treasuries, the UK gilts, EU bonds, and even the Japanese bond market, right? In terms of volatility, when you convert the Chinese government bonds from renminbi to US dollars, it's actually have an annualized volatility of about 4%. And that volatility is actually inherent due to the FX kind of movement, and is not actually inherent due to the price volatility. So you could see that actually it actually debunked the myth that Chinese government bond is actually very volatile. It should be volatile because of the COVID-19 that is believed that China is actually the epicenter of that outbreak. In fact, it is a myth. It is wrong. The volatility of the price is not there, right? So it's actually very stable in terms of when it comes to volatility. So that is actually why it's going to be beneficial for investors to actually include this into their portfolio, right? And having said that, very strong risk return profile, then we look at, is there any co-relationship with other major bonds globally? And again, when compared to the 4 major developed market bond markets, right, it has actually very low correlations. So it offers investors the benefit of diversification if you include that into your portfolio, right? So your next question is, why should we consider adding into Chinese bond market portfolio into your portfolio, right? So if you're actually a seasoned fixed income investors, you can actually add this into a portfolio because they offer diversification. Now, if you have actually a wider portfolio besides fixed income and you have equities, and we found that if you were to include Chinese government bonds into a portfolio, it will definitely help you in terms of your risk return ratio and also your portfolio's volatility, right? We found that if you were to put Chinese government bonds against the STI index, just to represent the Singapore stock market, it has a negative relationship of 0.4. So again, it helps you in terms of diversification benefits, right? And if we're looking through a 10-year cycle, right? Let's say from 2010 to 2020, and if you're holding a full 100% Singapore stocks, you're going to face an annualized volatility of close to 14%. And that will only give you an annualized return of about 2.35%. Why the annualized return is so low? Because most of these stocks within STI are mature markets, value stocks itself. Is not high growth stocks. They're more of a dividend kind of paying stocks itself. And you're looking at the volatility and the annualized return, that will actually give you a risk return ratio of 0.16 itself. Now we move along the chain, we tweak a bit, we add a bit of more Chinese government bonds into the portfolio. We found that the optimum, again, this is actually back testing results. This is not a recommendation, but we just found that this data shows that if you have 20% stocks and 80% into the Chinese government bonds, right, that would definitely bump down, push down your volatility a good 10% to come in about 4.65% volatility in the portfolio level. Right, they also bumped you up the annualized return to about 4.3% because of the strong high coupons that Chinese government bonds give out. That bumps up and push up the annualized risk return ratio to close to 1 at 0.92 itself. So again, to answer your question, how is actually why should investors include CSOP bond, CSOP Chinese bond ETF into portfolio? Because three simple reasons itself, right? It has very attractive yield, very strong credit rating, very low quotientship, versus other developed emerging fixed income markets and even to equities markets as well. This offers investors diversification benefits. It also reduces the portfolio volatility itself as well. Right. And just to share a bit more about our ETF, it's actually listed in September in 2020. Of course, the base currency is RMB. There are two currencies being traded, two currency classes being traded on SGX. CYC is the Sing dollars and the ticker with CYB is the US dollars. Both are fungible in the sense that you could buy the Sing dollars, you could sell into the US dollars, vice versa, based on your currency needs itself. It's an EIP product. We are committed to give out our dividends semi-annually in December, and so in June and in December itself. And our total expense ratio of this for any investors holding on to this ETF, it's at 0.25%, right? And we are fairly sure to commit at 0.25% because right now the asset under management for this ETF is US $1.45 billion. We receive support from sovereign wealth funds, endowment family offices, banks, and large institutions, investors as well. So, all right, the total cost for you, to enjoy, strong yield, diversification benefits, and low volatility is at 25 basis points a year. Yep. And how do you access this? It's actually listed on Singapore Stock Exchange with ticker code of CYC, Sing dollars class, CYB, the US dollars class. Kenny, you're mute.
Yeah, sorry. Thank you, Adrian.
Yes.
This is very interesting. It gives me a much better insight on this China government bond for portfolio diversification purpose. So beside this China government bond, I also have come across that another asset class which has been quite resilient and also have low volatility this period. And this none other than our own Singapore REITs. Okay, I will share my slide, Adrian. So, Adrian, can you hand over
Yep.
you start sharing? Yeah.
Got it.
Okay. I will share my slide to show everyone how's the performance of the Singapore REIT index so far. Are you able to see my screen?
Oh, good.
Okay, good. So amid all the negative events, basically we have four big negative events during this period. First started off with we have Omicron, then after that in some time in November itself, and also we have an interest rate high, and also Ukraine war. Now we are entering into the hyperinflation era.
Yes.
Basically, all of you know that when you go for a coffee shop, you know that how much inflation you are paying now, and also when you go and buy the egg, go and buy some of the oil from your supermarket, you know that it is pretty expensive now. So amid all this kind of negative news itself, basically you can see from this REIT index, they are non-event. Okay, and during that period, the only correction for the REIT index itself basically is about 9% correction. And since the war started, basically war does not have any impact on the REIT index. You can see that actually now rebounded strongly towards the next resistance level. Basically, it has been trading in a sideways movement for the past 18 to 19 months. And what would the future of the REIT index itself? All right. So we have already confirmed the 25 basis point increase by US Fed. So moving forward, if we are monitoring the past rate hike in 2016 to 2018, interest rate hike, basically you give a good support to Singapore REIT if the history repeat by itself. Okay, basically based on the last rate hike itself from the 0.75% until the 2.25%, the REIT index has climbed up about 30% in terms of the price of the index itself on top of a dividend yield of 6% per annum. So if the history really repeat itself and the US Fed increase the interest rate moderately, I am expecting the Singapore REIT continue to do well. And if you compare to other asset class, for example, Hang Seng Index and also Tencent and Alibaba itself, for the past 1 year, basically the REIT index is really moving sideways. So if your heart cannot take that kind of volatility, you should really seriously consider to include REIT into the portfolio. And while waiting for the breakout, while waiting for the S-REIT to really go higher, you are getting paid a 6% per annum dividend. Why not, right? It's better than parking your money into the bank. Basically, if you do nothing with the cash itself, the inflation, you'll be eroding the investor purchasing power. And S-REIT actually offer one of the highest dividend yield and low volatility compared to other stock exchange. You can see from here on the y-axis is the dividend yield, right? They are giving us about 4 to 5%. This is based on index, but if you look at the average dividend yield for the whole S-REIT market now, we are closing to around 6%. And in terms of the 90 days volatility, compared to the other stock exchange, S-REIT has one of the lowest volatility. What does it mean? Basically, you are just you can park your money into S-REIT itself, collect a dividend. At the same time, you can sleep well. You do not need to worry about the market volatility. One day can go up by 20%. For example, Alibaba, Tencent. One day can 20%. The other day drop by 20%. It's pretty crazy, that kind of volatility. Okay, so if you want to invest in S-REIT, beside invest in the individual REIT itself, but the disadvantage of invest in individual REIT, investor have to really do the homework, go through all the fundamental analysis and also technical analysis. You need to do a lot of homework. So there's another way to invest in REIT quickly, in a simpler format, and also immediately achieve a very good diversification. Basically, there are two S-REIT ETF listed in Singapore Stock Exchange. One is the Lion Philippe S-REIT ETF. The other one is CSOP IHS REIT Leader ETF. So, Adrian, to my question, because we already have a Lion Philippe S-REIT ETF listed in Singapore Stock Exchange for quite some time, why the CSOP want to list another ETF in Singapore, which is pretty similar to the Lion Philippe, because also underlying we have about 29 holdings and the dividend yield more or less the same. Why CSOP want to create another similar REIT and to be listed in Singapore?
Well, Kenny, that is a right to the point kind of a question, right? I would like to get you to actually move to the next slide, please. Thank you. Now, I may not be. I'm definitely not in the right position to comment more on why about how we compare up to each other. But I'd like to actually focus more on our strength in terms of our index and in terms of our ETF itself, right? A little bit more of the index is actually we are partnering with SGX with the index arm called IH. That's actually and partnering them with this index called the IHS REIT Leaders Index ETF. Right, this index has been a long time. It has been started off in 2014 March in that year. And right now the market cap is about over 115 kind of $billion as of this year, right? And there's about 28 names within this index. Now, we know there's about 42 names within the index, being 42 S-REITs listed on Singapore Stock Exchange. Now, we only allow in, the large and mid caps S-REITs into this index itself. what it means is that if your markets, your market cap is actually, you actually go through a free kind of selection criteria, right? New S-REITs must have, a free float criteria of 20% or more in the public. Free float means it's actually public arms, right? And hence, and and those in free float has to have a market cap of, $500 million US Sing dollars. Then you're considered as the large cap S-REITs. By adding the big boys into this index, we are also selecting also based on the liquidity, not only the size, but also the liquidity, how tradable the underlying S-REITs are, right? They have an average daily traded volume of US dollars, 500,000, or with a traded velocity of 0.1% itself. Now, once you are being identified as the large boys and very active traded kind of S-REITs, then the special unique selling point of this is actually how we weight these big boys. Once you have joined the club, who plays what position is actually based on the liquidity adjusted kind of methodology, which I'll just share more in details, right? The cap of each S-REIT is actually capped at 10%, right? And, we rebalance it in March and September itself. So right now, the sector breakdown is actually, we're actually more, the index allocation is actually more into industrial, office, retail, and data center. These are actually good sectors exposure because industrial and data centers are very good exposure to, the e-commerce, the new economy that is being sprouted out from the COVID-19. This also expects good exposure in terms of retail and office, because right now we have heard from our PM Lee has actually reopened the market, mask off, outdoor, alcohol can be sold after 10:30. There are more mobility within Singapore itself. They open the doors to our vaccines travelers. So we're going to believe that these are some very good sectors being exposed itself, right? And in terms of allocation, we are 64% is still allocated in Singapore, but rest of the allocation are actually very diversified to Australia, US, mainland China, Hong Kong, Japan, and even Europe itself, right? The next slide, please. Thank you. Yes. So why we like this index? Because the characteristic, because of this large and mid-cap S-REITs, is that we found that our factor back testing that this large and mid-cap have better risk-return profile versus the small cap itself, right? Looking through, March 2014 to September last year, historical return, annualized return, volatility, average turnover, even maximum drawdown, the large and mid-cap S-REITs have a better risk profile versus the smaller cap. So that's why we like the index so much. We want to decide to have an ETF to wrap around the index itself. Not only that, the importance of scaling up, right? When you are big enough to acquire more properties, you have larger, you have more properties, you're becoming you have a larger market cap, you have more stock liquidity, you're able to have higher valuation, and then you have able to raise equity cheaply, and then to acquire more properties. So this is actually a virtuous cycle, of the scale of large and mid caps S-REITs itself. The next slide, please. Right. So this is actually the key unique selling point of this index is actually this index represents the most liquid S-REIT market in Singapore, right? In terms of the traditional market, traditional indices where, the larger your market cap is, you get a heavier weighting. But now we are having this liquidity enhancement rebalancing to it, right? What I'm trying to say is that, for the last 6 months in between the rebalancing, if your REITs is actually actively traded, right, then you have a higher readjustment factor. If you're actually, very stable, very low turnover, you have a lower kind of readjustment factor. So the last rebalancing in September, right, Suntec REIT, CICT REITs have a very high traded velocity of 0.9 and 0.5 respectively. That's about 9 times and 5 times higher than the 0.1 stipulated by the index, right? So this means that when it comes to rebalancing in September, it has a higher readjustment factor. And when saying readjustment factor is that the Suntec REIT was actually at 2.88% market cap weight within the index itself. Because it was so actively traded, this means that there's actually investors' interest, there's actually fund flows, sector rotation that's actually happening within this in between this rebalancing. So this means that we want to offer the index, the ETF, and to the investors buying to our ETF a higher exposure to Suntec REIT, right? Because of there's a change in terms of sector rotations already. CICT, of course, unfortunately, was actually before the rebalancing was actually at 10%. So there's not much rebalancing to be done for us, right? You see, Keppel DC REIT itself was actually traded actively as well, 4 times above the 0.1% daily traded activities. 5.1% was the previous weight before rebalancing. It's actually being bumped up to about 7.5%, right? Maple Logistics, Keppel REITs as well are actually all bumped up a lot more. So this actually, what I'm trying to say that this helps the index, this liquidity adjustment help the index and the ETF tracking this, right? To capture fund flows, sector rotation, investors' interest, right? That actually better represents the current economic situation that's happening right now, right? So on the flip side, those S-REITs are actually very illiquid, like MUST, OUE, Commercial Trust. We're going to pare down their weights a lower. So like for the MUST, right, Manulife was actually about 2% in terms of weight. We actually pare it down to less than 1% at 0.8. So again, this helps. This is the key unique selling points of this index methodology. Liquidity. Liquidity means it attracts. It's actually reflecting, potential sector rotations that's happening in the market, helping us to track the relevant sectors that's actually more representing of the current market situation. Right. Next slide, please. Thank you. So again, this is talk about a key unique selling point is actually that that liquidity kind of monitoring, readjustment and rebalancing, to help us, the index, the ETF, and the stakeholder of this ETF to track fund rotation, sector rotation, fund flows, to help the index to be more exposure, to have a relevant exposure to the current market situation. Now, looking at this slide, what happened was that, true enough, the red box, that's what happens to everywhere. That's where the COVID-19 happened, right? And that's where not only the S-REITs, but global markets, everything fell. And we were all rushing to safe havens like the US dollars. But the white line, you could see that is actually our S-REIT leaders index itself has actually recovered so much faster than the rest of the market. That's actually offer investors, even though it's exposure to the same S-REITs, but a better outperformance to the investors. And rightly pointed out by Kenny, looking at the green box, right, that's where the interest rate hike happened in March this year. And usually, like you said in our chart, whenever the Fed says interest rate hike, that's actually usually the lift off of S-REITs in terms of price. And that's actually happening again right now, that the S-REITs actually have a lift off after the Fed says it's going to raise 25 basis points. What is going to help the market, like you say, Kenny, is that they are forefront to tell you that it's going to be 6 times more hike, right? That removes so much uncertainty to the market, and that's where analysts and researchers will actually just look at the fundamentals of underlying S-REITs itself, and usually the larger, stronger S-REITs will actually have a kind of outperformance than the smaller caps in terms itself, right?
Yeah, as long as they don't overdo it, and after that raise by maybe or
yes.
more than expected.
Yes, no surprises. No surprises. Yeah, the market love. Yep.
Right.
Yep. So again, just to stress, like from the since listing itself, we have actually outperformance in terms of when comparing both indices that's already in the market, right? Yield is definitely not the only story that we want to offer to investors, right? We also want to offer investors higher potential to capital appreciation, right? Higher yield probably means that the S-REITs are actually just giving out their incomes just to keep investors happy, right? We also want to offer investors to look at the total returns. In fact, total return means capital appreciation and also dividend yield itself. And you could see that in terms of the 5-year period, the index itself offer a higher annualized kind of returns, right? Dividend yield is about the same with our competitors, but in terms of annualized return, you could see that there's actually outperformance in that sense already. Yep. Right. So just a bit to share information of our CSOP IHS Leaders ETF. We adopt a full strategy, a full replication strategy. That means so this will be an executed investment product itself. Again, we have 2 currencies being listed on Singapore Stock Exchange. SRT is the Sing dollars. SRU with the ticker U, you could know it's actually US dollars. Again, both are fungible. You can buy the US dollars, sell into Sing, buy into Sing, sell into US based on your currency needs itself. Right, listed in November last year. We are committed to give out dividends semi-annually as well. Right, right now, one good thing about this ETF is that we are committed, and we are going to cap our total expense ratio at 0.6% annually. So any ETF investors who invest into this, holding on to our ETF, you know that your total expense, your maximum cost to you is actually 0.6% annually. Any other cost above 0.6%, the company CSOP will bear it and will not be transferred to the investors. So you know that whatever dividend yield minus 0.6, that is fully yours. Any other cost will be borne by the company itself. Right, next slide. Thank you. So just some key takeaways. To summarize, we like this leader index because it has exposure to large cap and mid cap S-REITs. The large cap, large cap S-REIT usually have access to quality assets, very strong sponsors and management itself. And the virtuous cycle of being a large cap, because of the economy of scales, that offers investors higher potential growth for capital appreciation and liquidity itself. Right, on the mid cap, offers investors just to bump up the dividend yield, yet being backed up by stable cash flows. It also offers sector diversification within the index itself, better representation for the index itself. You couple these 2 benefits into this ETF, it offers investors a smarter way to build a real estate portfolio. In terms of cost and tax efficiency, any individual investors who buy into this ETF, your dividend and capital appreciation will not be taxed by Singapore, right? And again, just to stress, the key rebalancing of this index and this ETF is actually based on liquidity. We look at the fund flows, we look at the trading velocity for the last 6 months in between rebalancing, right? Just to track the fund flows, just to track investors' interest, and possibly track the sector rotation to give investors and this index a better representation of the current market situation, right? You want to be exposed to the right market, the right sectors, to ride the wave of the reopening wave right now we are going through, right? Very attractive dividend yield. Forecast in 2022 this year by Bloomberg estimates, the dividend yield for this index is 5.1 minus 0.6. You still get a 4.8 kind of 4.8 kind of dividend yield return after cost itself. So very attractive. Full year estimate by Bloomberg again will be about 5.6% dividend yield. This is actually by Bloomberg estimates itself. So you get diversification benefit in terms of geographic and sector location. Right now, it's actually we're more exposed into office, retail, industrial, and data centers itself, right? Very stable asset classes because these are large S-REITs, right? They have actually very strong backers. They have actually quality assets. So you have very stable asset value in that sense. Very low volatility and very strong turnover itself.
Okay. Thank you, Adrian, for giving such an interesting insight for the 2 ETF offered by CSOP Asset Management. So I will hand over back to Christopher to see whether we have any questions from our participants.
Yep. All right. Now we have one question from Brian. He's asking that with potentially 6 interest rate hike this year, what should we look out for and when we invest in income products?
Okay, maybe I start from my view first as a financial advisor. My advice to the investor is first thing first, focus on our own investment objective, because when we invest, we always invest for the purpose of meeting some objective. So if you are looking to build a diversified portfolio with a different asset class, giving you the fixed income or passive income, basically all this kind of rate hike, I think that you only create the volatility in the market, but will not derail away from your meeting your passive income objective. So along the way, when there is a price is coming down, or when there's a sell-off in the REIT market itself, which means that any sell-off means there is an opportunity to accumulate. So as long as the investor focus on fundamental, based on the valuation, the yield is attractive, and also the portfolio is diversified enough, and also to ensure the REIT can give you a sustainable that kind of dividend to you, any sell-off is a good opportunity to accumulate. So keep on accumulating until you meet your financial objective during this period. So to me personally, rate hike is not something that I worry too much. All right, Adrian, do we have any other view?
Yes, totally agree with you in a sense. We have to look at the macro picture first. When interest rate hike, we have to look at top-down approach, right? Look at the macro picture, right? So again, when you look at income, right? So back to address fixed income, right? Usually when interest rate hike, definitely the fixed income will drop first, right? Fixed income, the bonds will drop first, definitely. But you rightly mentioned, so when the price has dropped too much, that's where the yield support will come in. Oh, it actually, dropped too much. It's actually looking at the valuation, looking at it's actually a discount. The yield is bump up, and if you track it back to the S-REITs, and this index is actually tracking a basket of leaders, right? The backed by our government and have a quality assets. That's where you actually should pick up some for the increase in terms of yield, the stability of the underlying assets as well. Yep.
Christopher, is there any more questions?
Yes, we still got. Actually, we have one more question from Jian Hao. Actually, he is asking which are the subsector within real asset that are most attractive going forward.
Yep.
You want to go first?
Yes, I think there's, even though Singapore has actually opened up, right, to welcome international travelers, want to boost tourism, and that definitely would actually benefit hospitality in that sense. Now, having said that, but that definitely has to also wait for the tourist sentiments to come back to actually to travel safe, feel safe to actually travel again. And so I think hospitality, there's still a lag in that sense, but right now the index and this ETF is actually exposed to the right sectors, which is the industrial, which is actually comprises of logistics and warehousing itself. Because we have actually inculcated the habit, right, to actually shop online, the e-commerce, they're actually being encouraged by the COVID-19. So e-commerce, industrial and data centers will definitely still an attractive sector to be exposed to. Now, I think the fastest sectors, there's subsectors in real estate is definitely coming to benefit right now from what's happening from this reopening story is definitely the office and the retail REIT. I mean, we have received a screenshot this morning. There's actually a long queue at ION, queuing up to buy some watch. And from a store, you could see that domestic mobility is the fastest to come back. Hospitality, while we're still waiting for foreign mobility to come in, going forward, I think right now, industrial and data center is still the right industry. The next attractive one would be office and the retail. Yes.
Yeah. For me, that I think that the short-term wise will be the recovery play. Basically, it's the retail sector and hospitality sector. So I think that we are expecting the long jam at the Causeway already. Right. But for longer term, I think that the growth sector would be the new economy sector, which comprises on the logistics and also data center. Right. So investors should really look at their own objective. Are they investing in REIT for capital gain? If they are looking for capital gain, basically need to look at the price to book valuation. If they are looking for just a consistent dividend payout, they should look for those REIT which have a very good track record in terms of the consistent dividend. So it's very much still fall back to the objective again before decided what sector to choose. Right. So there's another one more question to Adrian is why is the CSOP ETF bid price bid ask spread so high as compared to the Lion Philippe S-REIT ETF?
Yes. So usually the bid and ask spread is actually the duty of the market makers, which are actually the liquidity providers within on the stock exchange and on the trading screen itself, right? We engage them, we speak to them, you know, to maintain our neutrality in this whole ETF ecosystem, because we as an ETF manager, we just focus on getting the right exposure, looking at the ETFs, make sure it's well managed itself, right? We engage market makers to offer liquidity on the market. Now that is something that ETF issuers have very limited influence onto it. Should you need any kind of liquidity for your position, definitely you can actually reach out to your advisors, or you can actually reach out to us, and actually we could actually facilitate the trades itself to actually make sure to you get out in a very fair price. So I can't comment. I mean, I can't represent the market makers in terms of why the bid and ask spread is so wide compared to Lion. It could be also the reason is that Lion Philippe ETF has been around for a longer period of time, and there has been actually gained some form of traction. Now we are working hard to gain traction, but definitely you need to understand the benefits of the index itself. If you encounter any issues in terms of getting in and out of this ETF, do feel free to reach out to your brokers, to your financial advisors, or even reach out to CSOP, and we will facilitate that trades. Sometimes maybe the market makers are just quoting the price and quoting their price, but if you need it to be tighter, give us a call, and then we would actually get the market makers to say, hey, there is an order coming in, please quote tighter. Right, that's where we can come in to help in terms of facilitating your trade for this ETF.
Adrian, one of the questions I want to ask, and also this one is also one of the benefit of investing REIT using the ETF, which is the corporate action, right?
Yes.
As an individual investor, you know that corporate action is sometimes a nightmare to the investor itself. Sometimes you need to fork out more cash for the right issue. Need to make decision on the DRP, so on and so forth. So share with me, just give me some insight. I think most of the investors out there, they also want to know how the REIT ETF deal with the right issue, private placement, and also DRP, those corporate action.
Sure. So we work very closely with IH, our index provider, right? And usually we will take cue from it because we are tracking and managing this ETF passively. But definitely we have actually, when we receive the dividends, we will actually keep it in, try to minimize cash in terms of cash drag. We keep it less than 1% cash within the ETF. Now, should any rights issue happen, right, we will actually consult IH and the SGX in terms of what's the corporate action that they're going to take and what's their, what's likely is going to happen, right? We will take cue from it and say, usually, most of the time, in fact, we will actually take up the right issue, right? Because it's actually usually these new rights are actually given an issue at a discount. Definitely, we will definitely use that cash that we have in between distribution period to actually subscribe to the rights issue. This will actually prevent the ETF and the unit shareholders from dilution from this rights issue. So this is actually something that we would actually do it. So, but again, this offer is to investors that are actually investing into our ETF is that you wouldn't miss any letters or, things like that. Oh, I forget to subscribe to the right issues. They actually, being gone void and stuff like that. Let us manage those corporate actions for you. Again, the total expense ratio of this ETF is kept at 0.6%. Right? We will actually, watch out for you. We will actually subscribe all these rights issue, at a discount. To prevent dilution to the ETF holders itself.
Yep. Yeah, and good thing is investors do not need to fork out additional cash.
Yes.
Yeah, the asset manager, you do it on your behalf.
Yep.
So another question, we have 5 minutes left. So another question from Kai Lim. With the recent return of the prices of some S-REIT, do you think that there are some of the REITs are overvalued? Well, maybe I'll give my view first. If normally we look at the 5 years or 3 year historical price to book, and some of the REIT, and not many REIT are really trading above the valuation, the historical price to book valuation now. And most of them, even though some, especially those big cap REIT, they are trading maybe slightly below the historical price to book, and or 1 or 2 standard deviation below it. So personally, for me, that think that at the present moment, there are still quite some bargain hunting out there now at the present moment.
Yes, Kenny did bring out a very good parameter that we should look at price to book. In terms of price to book, actually our price to book is actually one of the lowest, right? Just coming slightly about 1.05, just slightly above the price to book for this index and this ETF on the average itself, right? And again, just before the rate hike, right? Most of the counters, most of the REITs are actually trading, at least about half of the 42 S-REITs actually listed on Singapore Stock Exchange are trading very close to their 52 weeks lows. I think right now there is still some form of fair valuation, or even a slight discount in terms of valuation that investors could actually write in. I think because the reopening stories has just only started, right? And that definitely could be a more potential upside for the S-REITs market itself.
All right. I think that we less than 4 minutes left. I think that's all for today's session, and thank you everyone for attending. Chris, you want to have a close up, or if the investor or participant, if they have any question, how can they reach out to us? Do you have any hint, Christopher?
Yeah. Maybe just you can share on how the investor can reach out to you guys.
Okay. So I just share my slide over here, right? I have a personal contact with Adrian, right? We have a WhatsApp group. If you want to reach out to him or reach out to me, basically you can scan a QR code and you can find me, and you can ask question from there. And if you have any question need to direct to Adrian, you just can direct to me. Maybe some of the question I can straight away answer on behalf of Adrian, so that we don't disturb him, right? Because at the end of the day, I am the licensed financial advisor. So normally most of presentation itself, before you need to make any investment decision, always consult your financial advisor. So I can be a first line of advisor to give you some to review your portfolio and give you some advice before you reach out to Adrian. All right.
Yes, you definitely could reach out to me with my virtual booth, right? Leave your inquiry and need be, right? Yep.
Yeah. Basically, I think Adrian, you are on LinkedIn also, right? You can search for LinkedIn. Yeah.
Yes.
So investor can look for us in the LinkedIn if you want to contact us directly. All right. That's all. With that, I'll hand over back to Christopher for you to do a closing.